Welcome to District 32, immersion, inspiration for ambitious business owners with big dreams.
Good afternoon. My name is Lorraine. I am from District 32 and I am absolutely delighted to be here today with Simon Turner from Fortuna Advisors. He is a legendary CFO. How are you going, Simon?
Very well, yourself?
Yeah, really, really well. It is Friday afternoon. It just gets better as the week goes on. So, Simon, first of all, I just introduced you as a CFO. Tell us, before we get into the topic, right, I'll let everybody know what our topic is today. Our topic is, so my statements show that I've got a profit, but where is the money? Right? Where is the money? And I've had so many conversations about that with people myself, so I'll be still interested to hear what you've got to say. But anyway, before we start there, Simon, what is a CFO?
Oh, look, so traditionally, CFOs are in the realm of larger organizations, and they act as the foil to the CEO. It's great to come up with a strategy for the business, but if it's not going to make you money, then there's very little point. So they tend to manage the overall financial strategic side of the organization, generally have a team of accountants and other members of staff. And they've always been pretty much the purview of the large corporates because of the cost involved in employing them. But over the last, I don't know, maybe 5 or 10 years, there's been a little bit of a shift for especially those of us with small business experience to start offering part-time services to small businesses, whether it's an hour a week for a one-man band just to have some advice if they've got some ideas, or whether it comes up to a day a week for larger organizations who need a bit more support. And we just basically provide that strategic financial support to them.
I think it's really imperative. You know, I did a session this morning with some District 32 members and more startup people, and we were talking about the importance of looking for profit. Because when you just go year after year after year with a salary and a job, but where is the profit in the business, you know? Exactly. I think it's really great. I wish that, you know, when we were starting out, we had that opportunity. I didn't know any CFOs at the time who could just come in for an hour a week and.
Yeah, look, I think over the years, those of us who are doing it have almost done ourselves a little bit of a disservice, because the majority of people don't know we exist. And that's why things like this, or all the blog posts that I put out and the webinars, it's about educating the small business community that we're there to help, and that we can provide you the support you need to add to your bottom line. That's why my LinkedIn strapline says I'm the accountant that will make you pay more tax, because if tax isn't a bad thing if you're making the profit, because the rest either is there in the business for reinvestment, or it goes, like you say, it goes towards the business owners.
And it's funny because people take a wee bit a minute or two to think, what is he talking about, you know, before the penny actually drops, because we're so used to being told the other way, right?
Yeah, the number of times, the tumbleweed moments when I'll say it in presentations, or I'll say it in network, even like at the Joondalup event or the Stirling event with you guys. The first time I said I'm the accountant that make you pay more tax, it was silence. Just silence. But then I started sort of explaining it, and it's good to see then that the business owners that get it, and the business owners that need a little bit of help. But yeah, the tumbleweeds are quite a common thing sometimes.
And we all need help. We all need help with the financial side of the business. Let me just turn off a little notification.
Yeah, the thing is as well is I need help with the marketing side of things. You can't be an expert in everything, and nobody goes into. I'm yet to find somebody who went into business so that they could spend Sunday afternoon doing their books at the kitchen table.
Yeah, that's right. So look, we can't be all things to all men. We can't be the experts in every area. But let's get into our topic today. Now, I have heard this so many times, right, with business owners. They say, my financial statements are back. It shows that I've got profit. It could be $10,000. It could be $150,000. I've got profit. I need to pay tax on this, but I don't have any money. Where did the money go? And then I'll say, you know, my response is, not being an accountant, I'll say, well, you know, surely you can see your incomings and your outgoings. But the response is, yes, I can see it clearly. I know where it's all come. It's all documented. It's all on there. I haven't taken any money out the business, so where did it all go? And I actually think it is a mystery. So Simon, please share with us some of your wisdom around that.
Kids to find out if they've taken it.
Where does it go? Where does it go?
Look, so everybody knows the saying, cash is king.
Yeah.
But that's an abbreviation of what a lot of people use as revenue is vanity, profit is sanity, but cash is king. So how many times we listen to commentators on business talk about organizations and they call them a 5 million turnover business or a 4 billion, and turnover without profit is pointless. You're just wasting your time. Exactly. And well, the other thing around that, if you haven't got the system, if you can't walk away from your business and somebody else just working it, you haven't got a business, you've got a job.
Yeah.
So a lot of business owners, when they come to try and understand the financials of the business, everybody looks at the P&L, and that's where you're talking about the income and expenditure. But not everybody looks at the balance sheet and understands the balance sheet. And the way I try and explain the two of them combined are very, very important. But one measures performance over a period of time, and one measures your strength at a given point in time. So there are a number of lines on the balance sheet. So the balance sheet is broken up pretty much into 5 areas, which is current assets, current liabilities. So that means that it's either money in or money out within the next 12 months. And then non-current assets, non-current liabilities, which is money or benefit in longer than 12 months. So cars, your machinery. Okay. If you've got a 5-year loan just started, 4 years of it is non-current, 1 year is current as a liability. And then the final area is equities, which is what the business owes to the owner. That's basically where the equity is. So that's pretty much where, if you've got cash missing in terms of your profit numbers, it's generally in the balance sheet somewhere. So when organized, there's a very simple line that people look at, and that's directors' loans.
Yeah, so okay. Here we go.
If the directors of the business are taking money out of the business, cash for their living expenses, for like pay the mortgage or whatever, but they're not recording it as salary, then it's not hitting the P&L. So that's the first big difference. Yeah. That's the most obvious big difference between the two. Is in a sole trader, it would be drawings.
Yeah.
But with a sole trader, it's there. It still gets covered as profit. So there's a balance to find between, and it's good to speak to your tax accountants about this. There's a balance to find between how much salary you take out for your living expenses and how much you take out on top as directors' loans. And then you get into Division 7A and all the rules and regulations around that. It's always a good idea when you first start your business to have a really good chat with your tax accountant, talk about structure, and talk about how you're going to take your money out of the business.
Yeah.
Because that's for me, that's pretty much the first port of call. And then we look at some other things. So for example, if you're a retail outlet, things like accounts receivable don't really matter because you're paying cash, you're getting paid cash. Whereas if you've got to offer something on payment terms, so say you offer 30-day payment terms, you've got to fund that sale from the time the invoice is raised. You've got to fund your business until that cash comes in 30 days later. Now, if your credit control procedures aren't really tight, and I've got written down procedures that I can send anybody who wants them. If your credit control procedures aren't really tight and your receivables balance keeps going up, that's more and more of your money in somebody else's bank account.
Yeah.
Because you've bought the raw materials, you've processed the raw materials, you've then sent the raw material or the finished product to the customer. You've paid for all that, and you're still waiting to get the cash in the door. So a lot of people get caught in the trap of once the invoice is gone, that's all they worry about because they can see it on the P&L and they've made a profit. For me, until that cash comes in, it's still just another risk of a cost. Because if you never get that cash, you've got to write the invoice off. You've made a loss on that deal of the full cost of what it's done to prepare it and send it. So you've got to manage your aged debtors. Just make sure they don't keep going. If the business is growing, they're going to go up naturally.
Yeah.
But it's really, really important not to offer too good credit terms, especially to new clients that you don't have a payment history with. On the flip side, then you've got things like stock. So if somebody's got a warehouse full of raw materials, instead of walking into the warehouse and looking at 5 meters of tubular steel sitting on a shelf, go and look at it as 5 meters of tubular cash. Because you paid for that. You've paid for that. You've paid for that raw material, and it's sitting on a shelf. And if it sits on a shelf for 6 months, that's your cash sitting on a shelf for 6 months. But if you're then buying more materials, because that one you're not really using, so you've got to buy something else, the more stock you've got sitting on your shelf, the more of your cash, it's bundles of cash sitting on your shelf, because you've had to pay for those under your whatever credit terms you've got with your suppliers. So the higher your stock numbers go, the more cash you've got going, the more cash you've got sitting idle or so there's, we'll talk about some KPIs later on that are important in terms of managing your overall working capital. They're the primary ones in the current assets. Okay. So your debtor balances and your stock is the primary number.
So what about then? I think that's all. I love the analogy there of of the cash that's sitting in the warehouse. But what about that? I mean, I've spoken to several people just recently about this because I knew I was going to be interviewing you. And they don't have payment terms. Mm-hmm. They have a salary, so there's no drawings coming out, and they don't have stock.
Yep.
They're like, where did my money go? Where's my profit? Where is it? They're still like.
So there's some other things that we can look at. I mean, all being equal, the cash should be in the bank. If they're paying themselves a salary, they've got no stock, cash comes in as they sell the goods, they pay for the goods as they buy them. Yeah. The only other thing to really look at is, well, directors' loans balances for a start. Yeah. And one other sneaky little line on the balance sheet is your leases and loans.
Yeah, okay.
So when you say you go and buy, especially currently with the instant asset tax write-off scheme. So if I went and bought a $20,000 car last year, I'd write that off completely as depreciation in the last financial year. It's recorded in my profit for last year, forget about it in terms of the P&L. However, if I financed that car and I financed it over 5 years, I've now got 5 years worth of cash payments with no benefit in the P&L, except for the interest, because you've already taken the value of the car into the P&L as depreciation. Okay. Does that make sense?
Yep. Yep.
So if I bought it on the 28th of June last year, and I've counted it in June last year, from July onwards, I'm making all the finance payments, which is cash going out the door, but it won't be reflected in the P&L except for the interest element.
See that? The couple that I spoke to might just be on the new car thing.
That's one of the sneaky little things that I just don't think of. So I mean, fundamentally, if like you said, if they're paying themselves a salary and that's the only money they're taking out of the business, they're getting the cash in the door as they sell the goods. They don't hold stock. They don't have work in progress. They pay for their goods as it comes in. There's very few other places that the cash could be other than the bank account.
Yep. That's why the heads are scratched.
quite simply. So that, I mean, that, yeah, often you find a business
need to come and see you, Simon.
Yeah, well, often you find business owners find it too easy to go and use their their debit card in Woolies. And when they're doing the shopping on a Saturday afternoon, because they think, oh, it's my money anyway. But yeah, a lot of the time, this is about managing the balance sheet as well as managing the P&L. And like I said, a lot of business owners I've met are pretty good at understanding their P&L, but very few understand the balance sheet. And
I think that's. I mean, I've been speaking to business owners and accountants for a long time now. You probably just explained that one the best that I can comprehend, being a non-accountant type person. I'm going to have to finish this interview and go and look at the balance sheet. Yeah.
I try not to delve into the technical side of things very often when I talk, because I don't particularly enjoy it.
It's really, really good. I can imagine everybody listening or we're looking at their balance sheet, while we're looking in here. But that would also explain, because I had another question for you. I mean, we talk to business owners every day, every week, every year. And I've heard the opposite stories where people saying, well, wait a minute, my sheets at the end of the year tell me, or if it's a BAS, or it might be an end of year statement that shows I've got a loss, right? And I've got all these losses in the business, but I haven't put any money in. Where is that money coming from that the business is eating up? You know, so it's like the opposite way. And but again, it's on the balance. It must be on the balance sheet, right?
Again, I mean, if you could make a loss because of depreciation. So there are non-cash items that go through the balance. That's why a lot of large corporates like looking at, they don't like necessarily look at profit before tax. They look at a measure called EBITDA, which is earnings before interest, tax, depreciation and amortization. So then if they've gone and bought a 250 grand machine and they've been able to pay cash in 1 year, so the capital they put in, they've paid for this machine. They've got to depreciate that over let's call it 8 years. They depreciate it over 8 years. For the next 8 years, they've got depreciation hitting their P&L, but no cash going.
Money. Yeah, okay.
Purely because they've already paid for it. So that's why it's important for people to understand, and it is really important for business owners to, and the cash flow forecast. Hopefully, the people have got a cash flow forecast. Yeah, but I mean, that's the biggest thing for me is just understand your balance sheet if you want to know where your cash is.
Yeah, okay. I mean, that's a great takeaway there from there, Simon. Thank you very much. But also, you mentioned there, you mentioned KPIs around that, and what should we be looking at? What are the red flags? Yep. What do we need to pay attention to?
So there's a thing called the working capital cycle.
Okay.
And it basically is, how long does it take you to turn a dollar out, or turn a dollar into a dollar plus profit into your bank account? That's basically what the measure is to me.
Okay.
And how you calculate is you take your stock days, add your debtor days, and take away your creditor days. And I'll explain each one. Yeah. So what stock days is how many days it takes you to turn a piece of raw material into an invoice, going out the door because you've actually shipped it and made it. Then debtor days is how long does it take you on average to get the cash in from the day the invoice goes out the door. And there's some very simple calculations that we use to calculate. But then on the flip side, then the creditor days element is how many days on average does it take you to pay an invoice pay the cash for an invoice you've received. So basically, when you look at those 3 KPIs as a whole cycle, that then tells you how long you have to fund your business for yourself. So say for example, if you on average take 16 days, the raw material hits the door, goes out to the customer and invoiced, that's 16 days. If it then takes you another 34 days on average to get the cash in for the invoice, that's 50 days. But if you have got credit terms, you're not forking your cash out straight away as soon as you buy the materials. So you deduct on how long on average it takes you to pay an invoice. So say that's 10 days.
Yeah.
You've then got a 40-day working capital cycle. Who do you think funds the business for that 40 days? You or the business. If it's an established business, it's got good cash flows already. But at the start, so when people look at, when I work with startups and I speak to startups, my first comment to them is, how much money are you going to need to fund your business for the first 30, 60, 90 days? We all know what it's like to start a business from scratch. So
don't do it.
No. But yeah, I envy people who can buy into an already established business.
Yeah.
But that's another story. Yeah, so if on day one of your business, you bought a piece of raw material and it took 60 days for the cash to come in from that raw material, and you've got to pay the wages, you've got to pay the rent, you've got to pay for the materials for your next job and your next job and your next job. You've got to pay wages, materials, rent, rates, electricity, gas, all that stuff for that 60-day period. So the idea is minimize your stock days by processing this. In the first instance, don't buy too much. So manage your stock, regular stock takes. And this is obviously if people have got stock in the manufacturing or whatever, regular stock takes, move slow moving stock. If stock has been sitting on your shelf for 12 months and you're never going to sell it for scrap. It's cash. If you're never going to sell it, why is it sitting on your shelf?
Yeah.
It's your cash sitting on the shelf. If the only thing you can get for it is scrap value, sell it for scrap and get the cash in. All right, it's a loss on the P&L. So what?
Yeah.
Cash. But on the flips, and we'll go into something else that is the opposite in a sec. Yeah. So the quicker you can turn your stock around and get the invoice out, and then if you have a really robust credit control system. So a lot of people wait until the due date of the invoice, check the bank, and then phone the customer if the money's not in. What I encourage my clients to do is 2 to 3 days after you've sent the invoice, quick phone call and just check that they've received it. Because that's normally the first excuse when somebody hasn't paid. Oh, we never received the invoice. Yeah, of course you didn't. And then say you've got 30-day payment terms. A week before they're due to pay it, give them a quick call. Just wanted to check that everything's okay with the invoice and just get a payment date off you. And that's when you find out, is it on hold? Is there a query on it? Or has it been approved for payment?
Yeah.
Or have we put it out for payment? We've not had it back. We need to go and find out where it is. Or they give you a payment date. And then you've got a lot more chance of being paid. One little tip I gave in the webinar I did recently on this, don't invoice late. Because if your payment terms are 30 days end of month, if you invoice on the 30th of June, you get paid 30 days into July. If you forget an invoice on the 1st of July, you won't get paid for it until the end of August, because it's 30 days end of month. So be really, really careful about what payment terms you agree to. Yeah. 2, making sure you invoice at the right time to make sure you get paid on time. Yeah. On the flip side, when we're talking about cash, overtrading. In the number of strategic planning sessions I've done with small businesses, my first comment is, what's your ambition? I want to grow. Don't we all? But what does that mean? Because if you grow too fast, you run out of cash. Because that's 60 days that you're funding your business. If your business is getting bigger and bigger and bigger and bigger, the number that you're funding in that 60 days gets bigger. And that's going to put real strain on your cash flows. Back when I was probably in my mid-20s, I was part owner of a small telecoms consultancy business, and we were going to do a deal with a really large broadband provider in the UK. I think it was worth 4,500 mobile phones. It would have made us millionaires. And we ended up losing the deal because the company we were using as a middleman for the mobiles themselves and as a carrier, they'd grown so fast, they weren't paying their bills on time and they failed a credit check. Wow. Yeah, literally. So
you went into accounting right there and then.
Yeah, but to be honest, I'd started doing finance. It was about maybe, I think it was around the time I got married, so 2001. So I'd only been really doing finance for about 4 or 5 years. And I just got asked if I'd be interested in getting involved in this business, but I was this was more of a side hustle for me. I was just looking after the financial side of things while the guys were doing the deals. Yeah. And we had no overheads. Our rent for the office was costing us 50 quid a week because we were 2 floors below a brothel in the city centre of Swansea. So we had no overheads.
Location.
Oh, massive. But we ended up losing a multi-million-dollar deal because the provider we were using failed a credit check at that time. And we'd been dealing with them for months. And in hindsight, maybe we should have done regular credit checks on them. But we'd been working with them for months. We hadn't had a problem, but the size of the deal meant that we lost the deal altogether, and they went with one of the major carriers instead. Yeah, devastating. I'm not bitter.
Yeah, no. But it's interesting when you're talking about that, you know, I mean, how do we forecast the growth? Because you need working capital to grow, even if you don't have these 30, 60, 90 terms, you still need working capital to grow. And I could never understand that, you know, and we were a smaller business and you go up, I'm like, well, we'll just make more sales. Yeah. And the sales will just have all this extra revenue to go. It just doesn't quite work like that. You know, it just doesn't, because by the time, you know, you grow a bit, increment a bit, grow a bit, increment a bit, and you've never got, you know, or it's unlikely that you've got hundreds of thousands of cash flow just sitting in your bank ready to grow or take the next step.
But if you want to go to the bank for funding, they're going to ask you where your forecast is.
Yeah.
And if you can go to them with what's called a three-way forecast, which is the P&L, balance sheet, and cash flow, if you can put a three-way forecast in front of them, they at least have the confidence that you've thought about it.
Yeah, okay.
You've actually sat down and considered the impact of the growth on the business.
Yeah.
Whether they then agree the deal or not based on the numbers is another thing, but at least you've actually sat down and considered it, which will give them more confidence that you're serious about the growth of the business.
And it gives you some more clarity in your own planning. Take some time out. Look at pulling it together for yourself.
Well, if you do a budget, it forms the basis of your management reporting on a monthly basis. Because if you've got something to compare your actuals to, then at least you can see it. So the analogy I use for budgeting is we all know where we are now. We all know where we live if we're not already there. Now shut your eyes and try and get there without opening them. And that's what your budget does. It gives you your checkpoints. It gives you your guide, your waypoints. You know that you're expecting to be at this point by then. When you come to do your management report, then it'll show you a variance between your budget, positive or negative. That then gives you an indicator of what to go and investigate why. So I worked for a company years ago and we had massive material variances on the shop floor. And we just couldn't work out what the problem was. So I literally went down onto the shop floor and spent 2 days working, talking to the guys. And it turned out there was a crack in one of the dies on one of the molding machines. And it was just spitting raw material out the back as it was pushing the stuff out the front. And that's literally what it was. We had a new die fit, manufactured and installed. Material variances disappeared.
Wow.
So yeah, it's all KPIs are indicators. They're not the end of the story. They're there for the operational people to go and find out what the problem is.
So you're giving me some good insights today. It's one of these ones you hear something you want to just go away into zero, have a good look around. What is there anything else that you want to share with us, Simon, around things we really have to focus on?
Cash.
Cash. Too busy. Cash. Yeah. More cash.
And when you think you see an opportunity, really think it through in terms of the finances. Because again, I go back to, we always measure a business on how much revenue they do. We never measure a business on how profitable they are. When we talk to everybody, when you see the news, when you go to networking events, or when you go, how much do you turn over? Who cares? How much profit do you make is what's important. What's the point of going and doing $1 million of sales, celebrating $1 million of sales when it costs you 1.1 million to make it? It's just cash, and just always have profit in the back of your mind. Is this something that's going to add to my business from a financial perspective? Anything you do, because every single thing you do in a business has a financial impact, no matter how small.
And it comes down to doing the planning, right? It's the planning, the forecasting, and the sitting down with someone who's not in the business, who's not inside the tin, to give you an external, bird's eye view perspective on the money.
I was doing a strategic planning session with somebody a little while ago, and they wanted to grow their revenue by 50% in the following year. Well, one, that's pretty big in and of itself. No matter what size your business, 50% growth is pretty big. And then the 5 different sections of the planning document I use is ambition. Where do you want to play? What does success look like? Capabilities and resources that we need, and management systems. And when we looked at the capabilities and resources, my comment to him was, how much capacity do you have in your current machinery setup? And he said, well, we're currently operating at about 85 or 90% capacity. I went, oh, how are you going to get 50% revenue growth from 10% capacity? So then it's a case of, do we revise the growth numbers, or do we go and get new machinery? But then again, that's another financial impact into your budget if you have to go, because that's cash out the door. And it's also on the depreciation side, forget about the instant asset tax write-off scheme for a minute, so that's not going to be there forever. So it's just, when you're looking at all this type of planning, everything interacts to become a financial inflow or outflow in your bank account.
And to you, that seems like common sense, but to the business owner, again, who's inside the tin, doesn't think, again, how much working capital do I need to increase the capacity?
It's the whole wood for the trees thing. When you're working in the business, it's very, very, I find it really difficult sometimes. And I've been doing this for 27 years. I find it difficult to stop and think about the impact on the P&L. because you get so caught up in, I'm going to win a new deal, or this is going to be great for the business, or whatever it is. It's so easy to get caught up in that, that you forget that there's a bottom line.
Yeah.
And if that bottom line is negative, why?
There's something wrong.
Well, why would you do something that's going to cost you money all the time?
Yeah.
At the end of the day. So yes, that's the
there you go. Simon, thank you very much. You've shared some real beauties there, and you've also really simplified things for me. And we're not kidding when I said I'm going to go and have a nosy at the balance sheet. Maybe I'll have some more insights about, the lifetime of the business. What's that?
Send it over by email, and I'll give you a once over if you like.
Oh, thank you very much. Look at that. There's a gentleman. Look, thank you. So you've shared some tips. You've told us, the difference, where to find the hidden profit or the hidden losses that's on the balance sheet. You've spoken about cash being king. You've spoken about the revenue in comparison to profit, in comparison to cash flow. Told us what to look out for. And at the end of the day, your message is cash, 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 and more cash. And don't go below the bottom line. Go and speak to somebody.
Cash will build your business long before lack of profit ever will.
And how can people get in touch with you, Simon?
You can either give me a call on my mobile, which is 0418 375 260, or drop me an email at cfo@fortunaadvisors.com.au.
Simon, thank you very much. It's been great chatting with you. I'll chat with you again soon, and enjoy your Friday and the rest of your weekend.
Brilliant. Cheers.
Thank you very much. See you later. Bye.
You've been listening to District 32. Immersion, inspiration for ambitious business owners with big dreams.